So our view is that if they want to avoid surplus in the market in 2025, we actually have the fourth quarter of this year still looking relatively tight, but a surplus emerging next year if they follow through on their plan to filter that 2.2 million barrel per day of voluntary cuts back into the market. If they do that, we're headed for a surplus next year of more than 1 million barrels per day globally.
Hello and welcome to the 12th episode of Oil Insights. I'm your host, Harry Tchilinguirian, Group Head of Research at Onyx Capital Group, and today I'm joined by a special guest, David Fyfe, Chief Economist at Argus Media. Before we start the show, as usual, please like and subscribe to the podcast. I invite you to also visit Onyx's LinkedIn and YouTube channels for more interesting and exciting content. I don't think David needs any introduction, but suffice to say that he's a highly respected oil market analysis veteran who also provides insights on cross-commodity markets, geopolitical risk, macroeconomic fundamentals, and so much more. Now, David has over 30 years of experience in the oil, energy, and commodity markets. And prior to joining Argus in April 2019, David spent 6 years as Chief Economist at Gunvor in Geneva. Before that, David was at the IEA for 10 years in Paris, where he headed the IEA's Oil Industry and Markets Division and edited the agency's flagship oil market report. David, here we are on November the 7th, looking at the US presidential election in the rearview mirror. The front-month January Brent contract is trading just under $75 as we speak at the time of this recording. And the election of Trump as the 47th president of the United States raises several questions for oil, both from an economic and geopolitical point of view. So we're going to be spending a lot of time discussing these issues, but we'll also look at the current state of the oil market fundamentals and the choices that OPEC faces in December when plotting the course of its supply. In this respect, I do not recall a time so late in the year where there's been such discrepancy in assessments of the fundamentals and the forecasts, with China at the center of contention. Now, let's start the show. David, welcome.
And, thank you, Harry.
I thought we'd kick off right away. With the results of the U.S. presidential elections in. There are obviously multiple implications, and perhaps I think the most important part for me is really foreign relation and foreign policy implications of new Trump presidency. And I thought we'd begin with sanctioned countries. So perhaps we could kick off with Iran and Venezuela and start talking about those before we move on to really the bigger elephant in the room, which is Russia. So, the U.S., under a new Trump presidency, do you think we'll have a repeat of what we had when Donald first assumed office, maximum pressure on Iran, sanctions being implemented with rigidity, if I could put it that way? What's your take on Trump 2.0?
Well, thanks very much, Harry, and thanks for having me on the show. I think you're right. The Trump campaign has made plenty of reference to Iran. Bogeyman number one, if you like, from potentially from the Trump administration's perspective. I think a lot really depends on how they see the market going forward. Gasoline prices are still a big issue, and arguably they've been an issue in this election just gone. Inflationary pressures are an issue. I think the key thing is, and we'll talk about this a bit later on, if the risks for the market in 2025 and 2026 are looking a little bit softer, prices look a little bit softer, then in a sense, it opens up the way for a rather more aggressive posture towards Iran or other sanctioned countries. But the key thing here is what has changed since last time we had Trump in power. You have most of the 1.5 million barrel per day of Iranian exports. It's essentially going into Chinese independent refiners. It's being sold not on a dollar-denominated basis, and it's being shifted by the dark fleet. So although I suspect there will be an attempt to tighten up sanctions, The actual impact of that and whether China or Iran actually pay very much attention to that is another matter.
I mean, it's very interesting because you kind of introduced the idea of conditionality around global fundamentals. Obviously, one aspect of keeping Americans happy is having a price of gasoline at the pump that is low. And so if we were to take out, you're mentioning Iran exports roughly about 1.5 million barrels a day of crude. Now, granted, maybe that crude is mostly headed to China, and if it were to be stopped, then China would have to look for alternatives, bidding alternative barrels, which would probably help maybe keep up prices. So, I mean, it's quite interesting. My view is that there's an element, and we'll also talk about this in the context of foreign policy and geopolitics with Israel, where there may be an element there where a maximum pressure campaign on Iran could possibly also look at the political side of things, where the U.S. could adopt that kind of stance to please Israel to get maybe concessions out of them. We'll talk more about that later, but that's quite interesting. And when it comes to the other sanctioned country, Venezuela, that I mentioned earlier, do you really think there's going to be much change relative to Venezuela compared to what we've seen under a Biden administration or even the first Trump administration?
Well, we had 4 or 5 years with literally, close to zero exports out of Venezuela. Now we've had a little bit of a rollback of some of the sanctions on the condition that the Venezuelans are allowed free and fair elections, which I think demonstrably they probably didn't.
That's an understatement.
There is a carve out, of course, for 200,000 or 300,000 barrels per day of crude to go into the US. And remember, the US Gulf Coast refining system, heavily complex refineries. There's a shortage of heavy sour crude out there in the market at the moment because of OPEC plus cuts. So is there really an appetite to, preclude that oil altogether? That's one thing. The second thing is that, the Trump administration has made hay with illegal immigration. Where is the biggest flow of illegal immigrants coming from at the moment? It's from Venezuela. So if the Trump administration really went hard after Venezuelan oil exports and really tried to cut them off altogether, you might be talking about the outright collapse of the Maduro regime and an even bigger stream of refugees coming out of Venezuela into the US. So it's more complex than some of the headlines from the campaign suggests. There have been a lot of sort of easy policy prescriptions. The hard part is actually governing and seeing what some of the unexpected consequences might be. So that's not to say I don't think he'll try and tighten sanctions, but he may just hold back a little bit because of some of these unintended consequences that I've mentioned.
It's interesting because you were mentioning obviously a deficit of heavier sour grades as a result of OPEC cuts. And I just think, from my point of view, do you think it's fair to say that Venezuela is probably not top of the list in the first 100 days of a Trump second presidency, and maybe we're going to get some accommodation for companies that operate there, like Chevron, just to keep that oil flowing, but really no particular advance or reprimand, sort of a status quo, comfortable status quo right now in terms of what's happening with Venezuela?
I think that would be the working case scenario. So feeding through our oil balance there is neither an outright termination of Iranian exports nor the removal of the sort of 400,000 or 500,000 barrels per day of Venezuelan exports. That's not to say it isn't a possibility further down the road. But, as I said, the business of actually governing as opposed to being on the campaign trail raises complications and, inflationary impacts that probably Trump, just as much as Biden, would have liked to have avoided.
Yeah, no, absolutely. So, I mean, all told, between these two countries, more or less status quo on Venezuela, perhaps some pressure developing on Iran. So we may not lose I think back in 2019, 2020, Iranian crude exports fell below 500,000 barrels per day. Maybe if there is some pressure, they lose 500 KBD, continue to export 1 million barrels per day, perhaps. That could be a sort of middle of the road scenario, depending on, as you mentioned, the conditionality on oil balances. elements, of geopolitics with China, all that could come into play.
I just wonder whether the Chinese purchasers of Iranian oil are, I mean, I'm not going to say that they would be completely indifferent to being under US sanction, but the levers that the US administration will have to bring pressure to bear, given that these are non-dollar denominated transactions, given that they are the ships that are involved are already vessels that are sort of on people's blacklist, if I can put it like that. How much more effectively can the administration do? I think what is even more interesting regarding Iran is what you alluded to earlier regarding Israel. And, I'm sure we'll talk a little bit more about that dynamic within the regional context
Absolutely.
in a moment.
So let's turn to as I said, the biggest elephant, but we could have called it easily the biggest bear, because after all, Russia tends to be portrayed that way. So, I mean, from my point of view anyway, saying that Donald Trump has a penchant for Vladimir Putin, just as Joe Biden has a penchant for ice cream, is maybe a bit of an exaggeration, perhaps. But all joking aside, the relationships that we could expect between this new administration, a Trump administration, and Russia undoubtedly are going to be different. And Donald Trump during the campaign has went out there and claimed that all he needed was to pick up the phone, and in 24 hours we could resolve the whole Ukrainian issue. I'm just trying to think in terms of geopolitics implication for oil markets. How do you see the relation between the U.S. and Russia evolving? Is there an opportunity here for Donald to actually create some kind of breakthrough, or even maybe I could go a little bit further, force a settlement in such a way where maybe there's territorial concession or denial to NATO access. I don't know. What do you think that a President Trump can do relative to Russia or his relations with Russia compared to what we had, in the current administration that's still in power, right?
I mean, I think probably the big difference between a continuation of Biden, i.e. Harris getting elected, and a Trump administration may be timing on the Russia-Ukraine issue. Because I think there's a fair amount of war weariness, not surprisingly, really on both sides. And so, it's perfectly possible to see that had we had a Democratic presidential victory at some stage, the two sides really would sort of grind each other to a halt in military terms, and therefore there would have to be some sort of negotiated settlement. Trump has said that he wants to prioritize this and get this sorted in sort of double quick time. So it may be a question of timing. The trouble is you have such conflicting priorities. You have the Ukrainian side, which is saying, it wants to go back to sort of 2014 or pre-2014 borders. That's going to be a very big ask, I think, whichever way that you look at it. Russia is probably going to demand an indefinite, no Ukraine in either EU or NATO.
No, you'd include the EU as well.
So you've got the irresistible force and the immovable object here. So I think I'm not sure it's going to be quite as quick a win as Mr. Trump might put it, as he's saying, but I think he will certainly push. The second part, or implicit within your question, is does that suddenly open the gates for the reintroduction of Russian hydrocarbons back into Atlantic Basin markets once again? U.S. was a minor buyer of Russian crude, a couple of 100,000 barrels per day before the conflict began. Obviously, Europe and particularly Mediterranean refiners were the key market for Urals. The point is, politically, I think Europe has been very heavily scarred by this. It's been economically scarred, but it's been politically scarred. And it's kind of difficult to see the entirety of European buyers and refiners being allowed to pitch back in and buy that crude straight away. Now, in some senses, the G7 price cap mechanism that was put in place, it was quite clever. It was quite cute because it allowed the volumes of oil to continue to flow. But essentially 3.5 million barrels per day of Russian crude exports now essentially go to Asia instead of to
two countries, really.
Essentially India and China. But the overall volumes of Russian crude exports really haven't moved, haven't shifted at all. What the Biden administration was beginning to show frustration with is the fact that this year, apparently, Russia's oil and gas revenues are up by about 30% year on year for the first 10 months of 2024. So, there were two goals of the price cap mechanism: sustain volumes, but cut revenues. And although revenues are probably lower than they would have been before the war, nonetheless, they're rising once again. So this, certainly from a Democrat side, they were probably going to get more aggressive in terms of tightening sanctions. With Trump, much more difficult to say. As you say, the relationship, the Putin-Trump relationship is, shall we say, complicated.
Yes, I'm not sure that, unlike many world leaders, Putin jumped to his telephone or to Twitter to congratulate Donald Trump on his second election. I mean, the way I look at it is, how when Donald Trump first came to office, the top priority, really, from a foreign policy perspective, is one, he went to, and we're going to talk about this again, he went to Saudi, but what was the imminent fix? And it was like North Korea. That was the top of the agenda. Top of the agenda for Biden was obviously trying to reinstate the nuclear deal with Iran. But given the pressures that he faces domestically from within his party around how much money is given to Ukraine, how much military support is given to Ukraine, I'm thinking that whether Volodymyr Zelensky likes it or not, Trump, if he wants to broker a deal and do it quickly, there's going to be an element of, well, you may have to let go of the contested eastern regions of your country that you didn't control anyway prior to the war. Maybe we'll have to acknowledge, some form or another takeover of Crimea. And then, as you said, add other constraints, no NATO access, no EU access, perhaps. And then if you get that kind of a deal, there's a lot of ifs in what I'm saying, right?
It strikes me that the negotiating points that you've just elaborated and itemized, that's probably several steps too far for the Ukrainian side. Now, they may not have any choice. They're under a lot of military and financial pressure. But actually asking Ukraine to give away all of those things, I think, is a very, very big ask.
Oh, I didn't. No, definitely, I'm not saying it's negligible, and that's why I sort of preface it with Volodymyr Zelensky would not be happy, but
there's got to be quid pro quo.
There's probably going to be, well, yeah. And I'm just trying to think, what would if Donald Trump was in a better position to broker some kind of peace, some kind of resolution relative to President Biden, if he wouldn't go for, all right, what do you want? And then say, well, the U.S. is prepared or not to follow. We'll see.
Yeah.
But
the key issue, of course, from our perspective, the market perspective, is do we reopen the gates to Russian hydrocarbons coming right back into Europe? Now, I suspect Russia would quite like a pipeline potentially in the event of some sort of deal being reached. The gas pipeline to be reactivated. European buyers, however, there may be one or two who financially would like access to that cheap gas. But I think there's going to be several important European buyers who were just going to say, we don't want to get caught in that cleft stick again and be held hostage again to that sort of eventuality for Russia's next territorial expansion, wherever that might be.
So at the end of the day, as I think this is an important part, because in the sort of order of implementation of sanctions against Russia, we had unilateral sanctions being imposed by the UK, the US, and then eventually the Europeans, and then the G7 caps that have been introduced. I would think that Russia would like to sell its oil above $60 per barrel, its crude oil if it can.
Well, it has been doing for
It has
most
been,
of the
but
period
it has been,
since
yeah, it has been
since
breaking. It has been, but technically, I mean, from a more
yeah,
remove the cap perspective. So I'm not
yeah,
saying that they,
yeah.
when you think back about it, there's always been
What
a,
they've made in terms of overshoot versus the cap, they've had to pay for in terms of transportation costs and
yeah.
dark fleet and all the rest of it.
So we could, if we imagine a scenario where that happens, it is really all contingent in terms of the EU following in the steps of the US and the political resistance. And then even if that political resistance was lifted, private entities themselves may be thinking twice about wanting to take that crude or be dependent on that crude or that gas as the case may
The
be.
trouble is we look at the EU as some sort of mythical harmonized whole. And of course, as we know, there are different strands of opinion within the EU.
Yeah.
There are parts of the EU that are still taking Russian crude and very happy to be carrying on doing so. There are others that who have felt logistically and in terms of transportation costs, the pressures, who might be more amenable to taking it. So, this is something that could be very sort of divisive
Yeah.
for the European Union, as if they're not confronting enough internal tensions already. This is another issue that's could be quite divisive.
You raised the gas issue, and we're also going to talk about a little bit about that later on in terms of domestic consequences, because they have consequences for the U.S. oil and gas sector. But it is certainly interesting if this does indeed unravel, and where, let's say, Russia is officially permitted to enjoy market prices on its crude and or its oil products, for that matter, where the rerouting of trade flows with, as you mentioned, essentially Russia managed to take most of its exports to primarily India and then and China. And India has always been very clear about this. They're taking the oil, they're abiding by the rules, so to speak, with a view that it's cheaper oil, and from an
Yeah.
economic perspective, it makes perfect sense from a trade balance perspective, balance of
Look,
payments,
you,
etc.
you and I both know, before the conflict, Urals traditionally traded a couple of bucks below Brent.
Yeah,
It's now trading sort of 12 to 15 bucks below Brent on a FOB basis, less than that, obviously, on a CIF basis. But clearly, Russia is having to swallow up some
some discount,
economic disadvantage, and they'd like to rectify that if they could, obviously.
yeah. So, moving on in this geopolitical landscape, let's turn our attention to the Middle East, because we sort of hinted at it. And I want to start with Saudi Arabia. I mean, the relation between the U.S. and Saudi goes way back. And 1951, I think the two countries signed a mutual defense assistance agreement. And so that's sort of a cornerstone of the relation between the U.S. and Saudi Arabia. Now, that U.S.-Saudi relation obviously has been, well, distended, if I could put it that way, and that's a bit of a euphemism. Candidate Biden had some choice words for Mohammed bin Salman, the crown prince, as he was running for the presidency, wanting to make Saudi a pariah state. And obviously, in his words, which were full of color, saying that Mohammed bin Salman was unfit for leadership. This in particular after the murder of the journalist Khashoggi. So Donald Trump, I mentioned this, when he became president, his first official visit abroad was not to a NATO ally or its friendly neighbors to the north. It was to the Kingdom of Saudi Arabia. He went to go see the king. So what can we expect now of these relations between the U.S. and Saudi? Because in the past, when they were better, for lack of a better word, the U.S. could lean a little bit on Saudi or when it required extra oil. Do you think that Trump has an opportunity here to at least amend a few things?
Well, I suspect the relationship will be rather warmer than it has been between MBS and the Biden administration. That, in a sense, is not difficult. And remember, Trump won. Was quite interesting what he was trying to develop under I think the Abraham Accords, trying to get some sort of agreement or a tacit acceptance by the Gulf Arab states towards Israel. And in a sense, that was quite interesting because it's saying we have this intractable Israeli-Palestinian problem, which of course, tragically, we're seeing the results of at the moment. But really, if you want to solve that, you need broader Arab world buy-in to, let's just say, to simplify, the right of Israel to exist. So it was an interesting way of trying to circle around the Israel-Palestine problem and getting some buy-in from the more moderate Arab states. Now, of course, with what we've seen happening, arguably you could say part of the 7th of October attacks may have been designed to undermine some of that Israeli-Saudi
certainly the consensus where they thought
rapprochement. And was that Iran behind that? The Iranians would hold up their hands and say, no, that was nothing to do with us. But in a sense, they would say that, wouldn't they? So do we get that the Abraham Accords sort of, reinvigorated? It becomes a rather roundabout way of trying to solve the Israel-Palestinian problem. And of course, we have a fairly intractable regime in Tel Aviv at the moment. It's kind of worrying to hear what's being talked about in terms of, what happens with Gaza after the conflict or after Hamas have been cleared out of the area, if that's even possible. So, this is a hornet's nest, and whether you're Trump or Biden, it's going to be equally difficult. But at least the mood music, I think, between the Saudis and Washington is going to be rather easier going forward. And if that could eventually, over time, lead to some lessening of these tensions within the region, that can only be a good thing.
So, I mean, certainly there's this, for me, there's like these two sides, the geopolitical side where an eventual lessening of tensions, and the other side, which is if you reinstate these tensions, are you able, like it was the case back in 2019, 2020, when you did apply maximum pressure on Iran, that the US got Saudi to step up production as an offset, or basically that opened the door. It could be to Saudi, it could be to other OPEC member countries that have spare production capacity to actually, finally, given what the balances are, the fundamental balances, if you take this much oil away, can you lean on Saudi Arabia once again? Will they be accommodating? For me, it's an interesting question if a second Trump presidency would enjoy the same kind of rapport in that sense. But there's this other aspect here. Talk about the Abraham Accords and the sort of easing of geopolitical tensions, as we've seen in the last recent weeks. And I think this was early October when Iran sent its foreign minister to Saudi Arabia, and he was greeted not by the foreign minister but Mohammed bin Salman himself. So I think that there's something interesting happening in Saudi Arabia and how it deals with Iran and its relationship with Iran in trying to keep an uneasy, or I don't know how to put it. It's just something where I'm thinking about, has the previous Saudi-US relationship, has that ship sailed now that Saudi is balancing various considerations, including maybe a more appeased relationship with Iran?
Well, I think a lessening of tensions with Tehran, is obviously in Riyadh's interest. Are they really going to reach out and have some sort of great accord? I'm not sure. You raised earlier in your comments the issue about the leeway that the US might have to tighten sanctions on Iran, with the tacit acceptance by the Saudis that they would raise production. Well, actually, if whatever way it happens, we lose a tranche of Iranian supply to the market, whether it's by tighter sanctions or, frankly, and more likely, by some sort of opportunistic Israeli strike in between
That's also a possibility.
the election and the 20th of January. We've heard a lot of talk about that. That could actually be the sort of green light that the Israelis are looking for now that the Biden administration is on its way out. So let's say we lose 500,000 barrels per day of Iranian supply capability and exports. I don't think necessarily the Saudis are going to say, okay, we promise to you, the United States, that we will fill that gap. They'll quietly do so. That will give OPEC Plus a bit of extra room to push the barrels back onto the market. So they don't really need to be seen to be, bowing to U.S. pressure in that sense.
Yeah, I don't want to make it sound like Saudi Arabia would need the U.S. permission to tie its shoelaces. Definitely not. But certainly, when you think about past relations, whether Russia, Saudi Arabia, when they had a tiff in terms of production, and Donald Trump was able to basically call leadership and intervene as best he could, I suppose, is one way of putting it. But there is that element where, yeah, if they want to leak more barrels in the market, they could do so. They don't need to wait for the U.S.'s permission. But I think for Donald Trump, it's sort of one of these things where you could go, well, if you want to produce more, if you remember, like under the George W. Bush days, Saudi used to produce a lot, and George W. Bush wanted to fill the SPR to 1 billion barrels, right? Up until we hit the hurricanes Katrina and Rita, and that had to stop. A promise by Donald Trump to fill that SPR could also be one of those enticing moments.
There are mutual areas of interest which don't have to be explicitly acknowledged by either side. But I don't think the Saudis and the rest of OPEC Plus would be too concerned if we lost some of the Iranian supply that has been pulsing through the market. But let's wait and see what happens.
Yeah. Well, you mentioned Israel, so this is a good opportunity to sort of talk a little bit about that. Now, we talked about that, and this is one of the aspects where I put out a poll on LinkedIn, and I asked the question as to whether or not, a Trump presidency is bullish or bearish for the medium-term outlook in prices. And one of the tenets of why I thought it would be possibly more bearish was that Trump is immediately seen as a disruptive figure. But at the end of the day, if we can bring, a country like Saudi Arabia within close to a sort of Abraham's Accord type agreement, if President Trump can lean on Benjamin Netanyahu, and if there is one person, because as we've seen with the war in Gaza, the Israeli government has been turning, hasn't had a deaf ear to virtually every other, Western leader out there when it came to trying to find a ceasefire, a truce to allow for humanitarian aid to get in, etc. Can Donald Trump have more sway on a Benjamin Netanyahu? That's the sort of consideration I was thinking of, because at the end of the day, if he can bring about a solution, and I really don't know what that solution can be, you're looking at diminishing that sort of whatever that geopolitical risk premium is in prices at sort of the longer term structural premium, if I could put it that way. You would, bring it down a little bit, a notch, something. So Benjamin Netanyahu was one of the most congratulatory leaders.
He got in early.
He got in early, but his manifestation in terms of congratulations for a second Trump presidency was perhaps a little bit more enthusiastic than some of the other leaders that congratulated Trump on Twitter or by phone. So what do we see any opportunities, or do you see any opportunities here?
As I was alluding to earlier on, I think there's a slight element of schizophrenia in Trump's approach, because on the one hand, as I said, when he was last in power, he was trying to develop these relationships between Israel and the moderate Gulf Arabs. On the other hand, he's very pro-Israel. He has a very good relationship with Netanyahu. And obviously that raises the risk that Netanyahu becomes more demanding, shall we say, in what he's trying to achieve militarily in the region. And that would be troubling. So it sort of cuts both ways.
Yeah.
I think Trump has, in a sense, more of a medium-term strategy than he has a short-term strategy for helping solve the Israel-Palestine crisis.
The only thing I could think about is in terms of, obviously both Democrats and Republicans have stated vigorously, and President Biden himself, that Israel has a right to defend itself, and they stand behind Israel, and that is true, whatever the political color you have in the U.S. But at the same time, I mean, if you recall, this was back in December 2017. Donald Trump officially recognized Jerusalem as the capital of Israel and would move the U.S. embassy from Tel Aviv to Jerusalem. So I think that's a step that no other U.S. president has taken. And it's obviously a very contentious step because it may negate a two-state solution that many people talk about. But at the same time, for the Israelis, how they perceive U.S. backing in the form of President Trump versus maybe in the form of, or could have been in the form of a President Harris is obviously very, very different. So I don't know, maybe Netanyahu listens a little bit more, or is maybe a little bit more open to concession. Honestly, I don't know, because when I think about it, again, it's like back to, maybe I'm too optimistic, back to Ukraine. Are parts of the West Bank that were illegally occupied by Israel returned, or at least some of them returned to the Palestinians in exchange of some form of truce? It's difficult to say how this is going to shape out. Really, it's a big uncertainty.
I think particularly for armchair geopolitical analysts like ourselves, maybe we should focus a bit more on the barrels and the dollars and leave the geopolitics
to the professionals.
Yeah,
that's right.
Where will that get us?
I don't know, but at least we could express an opinion on it. So, I mean, foreign policy, and we talked a lot about this, is not just about diplomatic and political relations with the various countries we mentioned, but it's also about trade policy. And then this is where we're going to start getting into the barrels a little bit more, because at the end of the day, Donald Trump delights himself in the word tariff. As he put it, I think this is the most beautiful word in the dictionary. Something like that.
Nice impression.
Nice impression. Thank you. Yeah. And so, on that basis, at least in the campaign, he was prepared to up the tariffs on China to 60%, if I'm not mistaken. Possibly even more in the case of electric vehicles, if you're looking at sort of targeted sectors and so on. And the IMF has come out quite clearly, its World Economic Outlook, indicating the dangers of escalating tit-for-tat tariffs. Do you think Donald Trump is ready to go on this mercantilist warpath using tariffs? And how far is he prepared to go?
Look, I think if you're looking at where the main impacts on global markets is going to come from a Trump 2 administration, it's all related to economic and trade policy. We talked about sanctions and geopolitics, and that's always interesting to talk about. But really, the combination of tax cuts, punitive import tariffs, and what seem to be swinging cuts in illegal immigration, which admittedly is a problem that the US needs to deal with. These are all super inflationary, which is ironic because the Trump administration has been elected largely because of disaffection by the US elector with prices in the US economy.
Yeah.
I look at what Trump is proposing from an economic standpoint, and particularly from a trade tariff standpoint. This to me looks super inflationary, not straight away, but once you get towards the tail end of 2025 and into 2026, I think conceivably you're looking at the Federal Reserve having to pull on the handbrake and stop its loosening of monetary policy and potentially go into reverse. This suggests to me that the US dollar is going to remain, relatively speaking, very strong compared to other currencies, where the Europeans are going to be cutting rates more aggressively because Europe essentially is in recession. China is in on the verge of recession, certainly deflationary pressures.
Yeah.
So, everything I look at says strong dollar, a real sort of fragmentation of trade flows. And when I look at the energy space, and if I'm China and I'm looking at this and I'm being told the Europeans don't want our EVs, Trump is going to tariff the heck out of all our technological imports to the United States, I'm going to sort of look at my own domestic energy economy and I'm going to say, well, I'm going to maximize deployment of new energy technologies domestically at home in China. And what that says to me is that the easing off in traditional Chinese hydrocarbon imports is likely to continue apace. In other words, we've seen probably peak hydrocarbon imports from China. That doesn't mean to say they're suddenly going to fall off a cliff. But if there's very little space in Western markets for Chinese technology, whether it's in terms of renewable power generation or EVs or whatever, they'll deploy it all at home. And so the requirement for we've just had the Chinese trade data out today, and the first 10 months of this year, Chinese crude imports are off by the best part of 500,000 barrels per day, year on year. And we can talk about oil demand and so on in a moment. But this is already beginning to. It's a narrative that is already, I think, feeding into the market.
So, I mean, one of the key takeaways from what you said is, again, it's like having to turn and look inwards. And we know that, for example, taking EVs, the Chinese industry is in overcapacity. A lot of, people point to the figures of EV sales in China and how they're exceeding 50% of new car sales, that kind of stuff. At the end of the day, we're going to be looking, of course, at China, again, transitioning maybe faster by design rather by economics. That's one thing. The other thing is, of course, is the nature of the retaliation that we could get. And so we mentioned, obviously, China being the obvious target of Trump's tariffs. But he also mentioned that he could easily increase tariffs on exports of other goods coming from the European Union. This morning I was listening to French radio, and producers of cognac are very worried because of Donald Trump, and that he may increase the levy on French goods, including wine and spirits. So,
do you know one of the things, and we have every year a sort of at Argus a sort of management retreat for a few days, and we're encouraged to sort of think outside the box. And what are some of the curved balls that might come out? And we were talking about CBAM, the Carbon Border Adjustment Mechanism.
Yeah.
And you get a new Trump administration in Washington, which ostensibly is pretty much against renewable energies and the Paris Climate Accords and all the rest of it. And I said, well, what if Trump has a look out there and sees that there's a whole bunch of tariffs going to be imposed on imports from the United States under CBAM. Trump is perfectly likely to turn around, despite his skepticism about CO2 and global warming, to say, well, I can do a CBAM better than you can.
Of course.
So who knows what it might provoke?
Well, that would be my button is bigger than your button.
The bottom line is, I see this fragmentation of global trade as being something that is eminently regrettable. It's going to raise costs. It's inflationary. It's not going to do consumers any good, whether they're U.S. consumers or European consumers or Chinese consumers. There really aren't any winners out there for this policy. And, I'm a European. I'm a Brit. I'm not going to sit here and tell the U.S. who to vote for or whatever. But I think this tariff policy of Trump could be incredibly damaging, both for the domestic economy in the U.S., but also for some of the U.S.'s main trade partners.
If we think back in the first Trump presidency, the pass-through of tariffs in terms of higher prices was relatively moderate in the first year and came in the second year took a long time for him to get them through. This time, he's going to walk in, he's going to be able to do it. And I'm just, more prosaically going, if, and undoubtedly, if one country is imposed tariffs upon, they will do the same. And maybe the consequences won't be as dire as IMF predicted, losing 7% of global GDP, or the equivalent of the GDP of France and Germany combined. But that would have to make us rethink our global oil demand estimates for next year and naturally the year after. Now, obviously, tariffs are sort of externally oriented. Let's talk a little bit about what President Trump would mean domestically. And so I want to read off something that President Trump said at the UN General Assembly on back in September 2018. And this is sort of, I think, a good scene setter. He said this, he said, "In America, we believe strongly in energy security for ourselves and for our allies. We have become the largest energy producer anywhere on the face of the earth. The U.S., and I guess this is the more important part, the U.S. stands ready to export our abundant, affordable supply of oil, clean coal, and natural gas." So this theme of energy independence, as Trump put it, I like to put it as energy dominance. Are we going to find that in a second Trump administration from a policy perspective, and whether or not he could actually do anything given changes in the shale sector? We certainly know that they're not operating like they used to when they first started. Maybe there's more impact in gas. What do you make of domestic consequences? So we talked about the two prongs of policy: tariffs, tax reductions, probably deregulation could be added to that. What does it mean for U.S. oil and gas in your view?
Well, the first thing to point out is that, yes, the US is indeed a net exporter of hydrocarbons, but interestingly, not for crude oil. The US exports 4 million barrels a day of crude oil. It's light, sweet crude, not best suited for the domestic refining system in the US. It imports about 6.5 million barrels per day of crude, which it needs to keep its refineries running with medium and heavier gravity crudes. So the idea that somehow the US at any time is likely to suddenly become energy independent for crude oil, I think, is fanciful. That's not going to happen. The second point, I think you noted this yourself. We've got past the Klondike phase of the US shale sector. Okay, when volumes were growing exponentially, all the money was being pumped back in to expand productive capability. Our view at Argus, and aside from our price reporting business, we have a consulting arm which makes projections on supply and demand and all the rest of it. We have U.S. crude production growing by between 200,000 and 400,000 barrels a day each year between now and the end of the decade, essentially. Okay, on average. Okay, it's within that range. It's not the million and a half barrels per day that we saw at the tail end of the last decade.
Right.
Why is that? It's because the sector has consolidated. You have fewer but larger producers who have competition for their own domestic capital resources. They're looking at LNG, they're looking at crude, they're looking at infrastructure, etc. So we think the days of, a million barrel per day plus of US shale supply growth are well behind us. Capital discipline has now become the new watchword. Now, at the margins, a more liberal, deregulatory regime in Washington will help US upstream expansion. I think it will probably happen in two key areas. I think increased licensing on federal lands and waters is probably something that could liberate a bit of extra offshore Gulf of Mexico production. And I think Trump straight away will throw in the dustbin the moratorium on LNG terminal expansions that the Biden administration had put in place that was, albeit being contested by the courts. Now, if you have much more LNG terminal expansion. That essentially is lifting domestic US demand for nat gas. And that gets producers in the US out of this bind where they're, it's $1.50 or $2 a million BTU for their product, and potentially lifts gas prices and gas supply much more than it does for liquids. So I think the impact of a Trump administration and the deregulation and the licensing and all the rest of it could be felt much more in terms of domestic natural gas production than liquids.
Yeah. I mean, I agree with you. The days of drill, baby, drill are in the rearview mirror. When you have majors that invest into the shale space, and you have consolidation, and you have different, I guess, approaches in terms of planning production. You set targets, deploy rigs accordingly. If your taxes are lower, or your regulatory environment is cheapening your operating costs, at the end of the day, that's just more money to either deleverage or return value back to the shareholder. It doesn't necessarily mean that U.S. oil liquids are going to expand at some extraordinary rate. For me, now we're into that, and I think you rightly put it. It's a mature. It's not even maturing industry. I think it has matured to a certain stage, and the planning of production is simply very different than back in 2010 when it was the Wild West, right?
But let's bear in mind, the US becoming an exporter of 5.5 or even 6 million barrels per day of liquids compared to 4.2 currently. That's a big expansion, and that's something that OPEC Plus has to keep in its considerations for what it's going to be able to do going forward.
I was going to bring up that point, but yeah, you brought it up. So, what I think we should not forget is, while the production or output may not necessarily increase at the previous pace, we may have an opportunity here for exports to start averaging above 5 million barrels a day consistently. And gas, well, obviously there's Donald Trump will just simply allow the export of LNG to non-free trade agreement countries, the biggest markets being China and Europe. So maybe not only we have obviously something to cheer about in the for gas, but also exports but again, there, right?
He's got to be careful, because he's talking drill, baby, drill, and let's open the taps in terms of LNG exports, and in the same breath he's talking about import tariffs. So at some stage there's going to be a conflict there between I mean, I suspect energy will remain the ultimate commodity that gets around trade barriers and trade tariffs, because it's so fundamental to every economy. But nonetheless, he's got to be careful with his tariff regime if he wants to be a major hydrocarbon exporter going forward.
I think your last point is super important, because we've been having this discussion here at Onyx as well, in terms of tit for tat trade measures being imposed. And I would say, why would anyone impose tariffs on, if you're an energy importer, why would you make your energy costs more expensive? So you may want to put tariffs on certain manufactured goods because you have the domestic production of that, or you are capable of domestic production of that. When it comes to energy, and again, harking back to what you said earlier, we're going to face a strong dollar environment. So if you're an energy importing country paying in dollars for your energy, be it your oil or gas, and then on top of that, you want to impose tariffs, then you're shooting yourself a little bit in the leg economically. So this is going to be certainly interesting, especially I just think about, relations again with Russia. The U.S. wants to be the purveyor of gas to Europe. So, and the Europeans now are looking towards the U.S. as they've built a number of temporary LNG terminals to be able to start getting gas from somewhere else. But that I think that's at the end of the day, for the U.S. oil and gas sector, more exports, but probably a bigger impact on the gas side than on the liquid side. I think that's fair to say. Now, I mean, this is now bringing us to we're now getting towards a little bit the end of our podcast, and we're going to be finishing off this podcast talk about actual fundamentals. And so I'd like to get your take of Argus Media in terms of how do you see the fundamentals for the end of this year and for next year? I think there's relatively strong consensus around non-OPEC plus countries and what they're contributing roughly. But we've seen, well, at least between the two prominent agency forecasts, the IEA and OPEC, a persistence in the disparity of their demand assessments, whether it's for this year, which is almost over, and for next year, a lot of it's centered on China. How does Argus see the picture in terms of demand growth for this year? Where do you guys land and next year? What's the thinking?
We've got a global number for this year, which has been revised down, and it's been revised down to a large extent because of what we've seen from China. But our global number for this year is around about, leaving aside a bit of loose change, it's about 800,000 barrels per day globally. And next year we have that quickening a little bit to just shy of 1.1 million barrels per day. So it would put us a little bit more in line with the sort of IEA-ish type numbers. We differ a little bit from the IEA, which I think still has positive growth in Chinese apparent oil demand. And remember, there's no such thing as measured barrels of consumption in China. You have to triangulate looking at crude runs and refinery output and trade of both crude and products to get to a number. We have a net decline in Chinese apparent oil demand this year of just shy of 200,000 barrels per day. Now, there are other numbers out there that are, have upwards of 500,000 barrels per day, particularly OPEC. Now, we think China probably will revert to modest growth in oil demand next year to 300,000 barrels per day, potentially. But, the sort of 1.4 million barrels per day of Chinese demand growth we saw in 2023 was a one-off.
Yeah. To me, I think, the macroeconomic reality, especially around China, we've been looking at the hard data, even the soft PMI measures. You've been looking at, I don't know, retail sales, fixed asset investment, industrial production. None of it is good. And then if you layer on top transition by design, where you literally, well, one could argue it is the richer cities, the coastal cities, the big urban centers of China where the EV penetration rate is at the highest. This does not mean that all of China and rural China is adopting EVs, but there is transition by design. So whether China, if it achieves anywhere close to a 5% growth target next year, whether that will deliver the same kind of amount of oil as it did in previous years for the same growth rate, I guess that's debatable. Well, we have this massive risk on the numbers for next year if we have a trade war. And
our 200,000 to 300,000 of Chinese oil demand or apparent oil demand growth next year is not factoring in major impacts from a trade war with the United States. Obviously, that would ratchet down potentially both imports and by inference domestic demand accordingly.
Yeah, I mean, it's going to be interesting because obviously the how people view the world and we're going to get more into the OPEC, is going to predicate policy for producers. And so when I look at the numbers for China in 2024 in terms of growth rates, the IEA has just short of 150 KBD. So that's, in a balance that when we're talking millions of barrels per day, that's in the margin of error. OPEC, on the other hand, is just shy of 600 KBD. I don't know what are the tenets there. And then next year, you're looking at Chinese growth, at least by the IEA, just north of 200 KBD. So they're pretty conservative. And OPEC is still holding on to...
When you look at this year, remember last year was so exceptional. We had revenge mobility at work.
That's true.
We had a huge build out of new petchem capacity that drove up naphtha and LPG demand last year. We had Chinese people suddenly being able to fly again, albeit there's a lot of nervousness by the consumer in China who has 60 or 70% of his savings tied up in the real estate sector, which is, going belly up at the moment.
Yeah.
And so this year was always going to look very disappointing for demand growth in China
It's almost
compared
negative base
to last
effects,
year.
right?
Yeah.
So if you
Yeah.
took an exceptional 2023,
It's not
then
surprising
you're not
that
surprising
this year
that
looks.
this year looks a little bit. But then prospects for growth, and honestly, I don't know if China is going to recapture ever a 5% economic growth target. But that's normal too. We're talking about an economy this is not the economy of back of, when we had the super cycle in commodities was 2004, 2005. Suddenly China, grew with a great velocity, voracious appetite for all forms of industrial commodities. We have a bigger economy, which normally means smaller growth rate, But that growth rate, I mean, even if they grow at 3% or 4% rather than 5%, it's quite a bit
There's
of
an
growth.
S-curve at work here, and shale was the same. We were talking about shale earlier on. It would be impossible for the Chinese economy to carry on growing by double-digit rates. It will taper off to levels, let's say, in a 2 to 4% GDP growth sort of world.
I mean, this poses a serious conundrum for OPEC Plus. Would you not agree? And we're going to show you, and just for sake of argument, doesn't necessarily mean that we agree with these numbers, neither David or I, but for sake of illustration, this is the IEA's. We're going to show you the IEA's balances for this year and next. And what you notice, these balances are made based on their supply and demand projections, and OPEC keeping its current cuts as they are for the entire forecast period. And what we note in the IEA's balance is that for every quarter, starting from Q4 this year and all of the quarters of 2025, we're in a surplus. And this is with OPEC maintaining its production cuts, including the voluntary cuts as is. So this raises a very interesting question, because OPEC the past weekend has delayed a decision in terms of tapering these voluntary cuts to December. So, David, are they stuck between a rock and a hard place?
Yes.
What's the yes? All right, that was next question. Moving on.
No, but we can elaborate. Yeah.
And what are the opportunities? How do they get out of this? Because I have a follow-up question.
And we're arguing about sort of loose change around demand growth estimates going forward. The key problem that they're facing is that we have a bit of a bubble of non-OPEC supply growth between 1 and 1.5 million barrels per day, not only this year, but next year and even in 2026. That's going to gobble up pretty much most people's expectations, reasonable expectations for oil demand growth going forward. So our view is that if they want to avoid surplus in the market in 2025, we actually have the fourth quarter of this year still looking relatively tight, but a surplus emerging next year if they follow through on their plan to filter that 2.2 million barrel per day of voluntary cuts back into the market. If they do that, we're headed for a surplus next year of more than 1 million barrels per day globally. If they then start to dismantle at the end of 2025 their mandatory cuts, the extra cuts on top of that 2.2 million barrels per day, potentially the surplus doubles in 2026.
It's quite frightening.
So this says to me there is really no net incremental demand for OPEC plus production between now and not only 2025, but 2026. Now, our working assumption is that OPEC plus does what it says on the tin, which is tries to balance the market. It will be cohesive, it will be disciplined, it will continue to do what is necessary to put in, let's say, a $75 Brent, $73 TI floor on prices. It will prevent a surplus and it will sustain market backwardation. That's the sort of ideal scenario for OPEC. The big question is, if that means giving up market share in China and India and the rest of Asia to Iran on the one hand and Russia on the other, are the Saudis going to play that game? Are they going to be happy to play that game
Well,
for at least another 2 years? Big question mark.
I was going to be a little bit controversial with you. If you recall, I mean, for me, like neither OPEC nor Saudi Arabia has any official price target. The best price they could get is always the best price, right? So, but if memory serves me right, back in 2017, the then oil minister Khaled Al Falih was actually regularly pointing to the level of oil inventories in OECD countries, where they were relative to their recent 5-year range. And that was, although not an official metric, but it was a metric that was actually acknowledged publicly by the Saudis. And when you look at OECD stocks, at least those reported to us by the International Energy Agency, they are trending, at least for the crude stocks, at the lower end of their recent 5-year range. So do you think that OPEC could roll the dice and say, you know what, if we have a little bit of surplus, it doesn't matter. It adds to stocks that are fairly low. So maybe that changes the structure of the curve to accommodate moving this stuff into storage, but hopefully doesn't depress the flat price too much. Do you think they could roll the dice on that kind of a metric anymore?
Well, look, I think post-pandemic, OPEC Plus has actually been pretty effective in limiting supply to the market and preventing an accumulation of inventory within the OECD, the visible part of the stock pie, if you like. Of course, they've had a bit of help from more recently by the high cost of capital. It doesn't really pay to hold more inventory than you can possibly avoid with interest rates at 5+%. So that's been part of the equation. But OPEC Plus has been very effective at doing that. Depends which way you look at OECD stocks. Do you look at the pre-pandemic historical average, or do you look at the post-pandemic historical average? So it's become a little bit fuzzy as to what the actual target for inventories might be. We see them in the OECD being relatively tight at the moment, and that has been a supportive factor for prices. I think that has certainly come in. What we're saying is the danger is that they overshoot in 2025. And you not only get OECD stocks moving back towards the sort of historically neutral level, but you start going even further than that, and you start building up a surplus.
I suppose that is the chance they take. When we look at OPEC production numbers and targets, there's some obvious cheaters, relative to where they should be. But it just seems to me that it's one of the issues that OPEC will have to contend with, because the OPEC Secretariat's views in terms of demand are basically ones that typically would then favor a return of barrels. They could then use again, as you're saying, this kind of important, it's like as a pre-pandemic or post-pandemic 5-year averages. We're looking at inventories now that are below no matter what. And that could be a pretext to add a few more barrels in the hopes that some of it goes into stocks, but you don't obviously want those stocks to overshoot, because then you have another problem on your hands. We'll see what they do, but it could be that the hands are tied for maybe the better part of 2025 before they could do anything. If, as you pointed out, they wish to maintain oil prices in that vicinity of between $70 and $75 ish. Again, it's very hard to say where it would land. To finish off on OPEC, I mean, there have been some prominent financial newspapers that have brought in this idea of market share wars, and you kind of touched upon it a little bit. Honestly, I don't see the Saudi Arabia going after U.S. shale anymore. They tried in the past very unsuccessfully. There's no reason to, in my view anyway, to have a market share war with your cohorts in OPEC plus. So do you attribute any validity to these? Because it pops up almost every single time whenever the price goes down.
I think
Market share war.
I think the point is they can keep that as a sort of an extra sort of sword in the armory, if you like, for internal negotiations. I would think there will be some disquiet within the kingdom about the extent to which Middle Eastern oil has been pushed out of, say, China and India by Russian and Iranian barrels, as we mentioned earlier on. I would tend to agree with you, though, that some of the sort of spending commitments that the kingdom has got for the next 20 years, not just
Well, this is MBS's
short
2030
term.
vision, right? It's a costly vision, right?
Do they really want to crater the price? Our working assumption would be no. But it's a fairly fine balance, and they have said before that they will not carry this burden alone. So if the cheating continues, and Iraq and Kazakhstan and even Russia gets a little bit more cheeky in terms of cheating, then the Saudis might reconsider. But if that doesn't happen, then I would have to assume that no, they won't.
Well, I mean, the issue of compliance with targets, and we've seen this in in all the latest official press statements on the OPEC website, where compliance is, put sort of at the top of priorities, where member countries have to fall in line with what was agreed, and of course, I guess OPEC Plus, hoping that as they do so, they manage to avoid surpluses in inventories and markets flipping into contango or too deep of a contango and so on. Well, I mean, David, we covered a lot of ground today, and we're getting, I guess, at the conclusion of this podcast. Are there any particular things that we missed out today that you feel that you'd like to tell our viewers?
I mean, we talked a lot about shifting trade flows. It's an exciting time, I think we are going to see, to a greater or lesser extent, more protectionism out there in the market, more barriers to traditional arbitrage flows. But what that means is there's going to be more opportunity out there to move material on new trade routes. Who would have thought that 80-90% of Russian crude would be going to the Asia Pacific in 2024? That's happened. And that's an opportunity both for traders, physical traders out there in the market, also for price reporting agencies to come up with some of the indices to help that physical trade develop, and so on. And I think there's more of that sort of thing to come going forward, when we look at what the EU is talking about, what China may respond, an incoming Trump administration. It's going to be an exciting time, new unthought of arbitrage flows for commodities, but that's a world of opportunity. So I think we shouldn't be all doom and gloom about what's to come. There's going to be opportunities for shifting flows of commodities going forward.
Okay, well, in these shows we always have a crystal ball moment, so I'm going to put you on the spot. We said, like, walking into the studio, Brent was trading just under $75. TI was around 71-ish. Do you want to make a year-end prediction as to where either one of these could end up?
I hate to be very boring here, but I mean, our fourth quarter number for Houston WTI, which we think is the creme de la creme of physical benchmarks.
Is that like the Donald of the TIs?
We're about $73 TI, so 75 Brent roughly. Let's call it, and we have the price next year oscillating for TI certainly in the first half of the year around sort of $76, $77.
That puts you back on an $80 Brent basis.
But it's crucially dependent on OPEC cohesion persisting. If what you say comes true and the Saudis get frustrated and decide that they're going to teach sort of cheaters a lesson, then obviously we'd be looking at something $10 or $15 below that. But that's not our working case.
Yeah. Plus, we don't know, again, the big sort of Damocles sword, the tariff sword on the economy and oil demand. Well, I mean, this is we're wrapping up the show. David, thank you very much for joining us.
Thank you.
David Fyfe is on LinkedIn and has a regular podcast where he opines on oil markets and all things commodities. So I really invite you to go check out that podcast. Argus Media is well known. They have a number of publications covering oil markets, from price reporting to analytics. So go have a look. I like global markets myself. That's always been one of my favorite weekly publications.
Right.
So, I mean, all that's left to say is for me is to thank you for joining us. Again, please do not forget to follow Onyx content, because our content is beautiful. It's huge, David, and it's the best content out there. So with that, that's a wrap. Thank you very much. Thank you, David, for joining.
Thank
Until
you.
next time.
Thank you, Harry.